Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, and this week we're sharing some edited highlights from a recent client webinar we hosted on geopolitics, the economy and markets. I was joined by Scott Livingstone, NatWest's international advisor, to discuss his latest views on the war in the Middle East, the potential paths towards resolution or ceasefire from here, and what he'll be watching most closely in the coming days and weeks. Ross Walker, our global head of economics, then ran through what the conflict means from an economic standpoint, how we're revising our growth and inflation projections, and what that implies for the path of monetary and fiscal policy from here. With events and the news flow moving relatively quickly, it's worth noting that this was recorded on Tuesday, the 31st of March, and all information was correct at the time of recording. Scott, thank you very much for joining us. I did say at the beginning of the call that I think you are the busiest person in the bank at the moment. There probably are some listeners on the call who dialed in 4 weeks ago at the beginning of the conflict when we hosted a conference call. We discussed, the potential scenarios. We discussed your base case that it was likely that we get a kind of intense period of escalation before potentially some resolution, some ceasefire. 4 weeks on, it would now be really good to understand your take on kind of where we are relative to that base case and what the next few days and weeks might hold.
Thank you for having me on this call, Imogen. I'm not sure we are in a completely different phase. I think from 4 weeks ago, we're in the phase of a broad understanding that the early plan was not successful and that we're in plan B, as it were. And the key component of that plan B is continual war fighting by the American and Israeli forces and a sufficient level of response from Iranians to impose an economic cost on the Gulf as well. So that's a continuation. And my expectation is that this phase, this level of military war fighting from both sides will continue for a number of weeks, I believe. And I come at that, Imogen, because I think that certainly the Americans have got three options, really. I think the first one is a very swift declaration of victory and a pivot away from the conflict. My personal view is I think that declaration of victory, I think it would be difficult to achieve at the moment without some form of demonstrable success. So some kind of military event on the ground that takes place, and we'll possibly come back to that. So the second option is to compel Iran towards a deal. And if you are looking for something new in this phase, I suppose it is the fact that we have had confirmation that channels are opened between Iran and Washington. I don't think they're at the moment in the productive phase, but at least the channels have been opened. So I think there is second course of action for Trump is to use military force to compel Iran to a position where it sees that its best interest for survival is in making a deal rather than in fighting. So I think we're some distance from that at the moment. Certainly the actions and the rhetoric coming from the Iranian side suggest that they're feeling rather buoyant. But I suspect that that would lead to the Americans feeling that they can be compelled towards that decision point. And the third option for the Americans is frankly continuing with the original plan, which is to use air power to destroy as much of the regime as possible until it collapses. Those are the broad options I think the Americans face. All three of them, for the time being, demand continued use of military force.
Picking up on that military force point, then, there's lots of chatter in the headlines around the likelihood of boots on the ground. What's your take on whether this is just negotiating tactics or whether, this is the next leg of escalation and actually route two of your three scenarios, using military force to compel Iran into some kind of a deal?
I think it's both. I think President Trump is known for enjoying his fondness for optionality. He likes having options at his disposal, and I think the Americans are putting together a sort of force package that give them options moving forward. Not too many options. It's a fearsome capability that the American ground forces that are being mustered present, but it's not an invasion force. It's not big enough for that. It is big enough for a dramatic raid of some kind, and we could see that, and we could see it being used as this, as I say, creating some form of deliverable, some sort of military deliverable that is then used as the peg on which to hang a declaration of victory. That it could be used for that, or it could be used in a more substantial way in terms of pushing the Iranian regime towards a deal. So much more of an escalation. Really using military force to, for example, reopen the Strait of Hormuz, or in some way control the economic benefits that the Iranians have from oil exports. And by the way, it's not only the Karg Island that's in the media. There are a number of other export terminals that those military forces could be used, should that be the option that President Trump goes for. That option does bring a lot of risk, I must say. I think the idea of putting boots on the ground for a prolonged period of time, I think brings a lot of risk, military risk, but then political risk on the back of it. So I don't think it's an invasion force. I think it could be used as obviously as a pre-negotiation lever. In military terms, I think it's more likely to be used to generate some form of event that can be the basis of a quick pivot, or it could be used in a very risky way to impose a cost on the Iranian regime and bring them to that point of making a deal.
Of those options and the sort of three scenarios that you outlined for the US from here, what kind of a time horizon are we talking about? From a
Yeah.
market's perspective, I guess we're most concerned about, when might the strait be reopened, or can it be reopened, and what kind of a time horizon might we be thinking about this? Of those three options, what sort of time horizon are you expecting?
The three broad timelines. There's a timeline about the war fighting, which I think is in the coming weeks through into April, but I would be surprised if it's sustained into June and July. There's a second timeline about the uncertainty in the region, and that could be to do with the negotiating a difficult deal, and that could last for a longer time period into the middle of this year. And then the third one is, I think, repairing the infrastructure, which could be multi-year challenge. But don't forget, during that multi-year challenge, it's not happening in isolation. There are other events. There are other particularly in hydrocarbon supply, there are other resources coming on stream or plan to come on stream at the same time.
What and or who will you be watching most closely in the coming days and weeks to have confidence in that scenario playing out, i.e. that this is, ending in April, May rather than June, July?
Yeah, so the obvious one are the Americans. What do they do with these forces? Are they kept poised, ready for action? So it falls into your point about being a negotiating sort of lever in its way, or are they deployed? And if they are deployed, are we seeing a very short raid, very measured in days or even hours, or is this something much more substantial? And demonstrates that Trump is willing to take this political risk of having boots on the ground for a prolonged period. So I think it is worth paying attention to the US force disposition and how it's laying down that maritime and amphibious and airborne now force. So I think that's the first thing. I think I'll also be paying attention to the relationship between the Israeli forces and the Americans. I mean, I think we have seen glimmers of a divergence of end states, of satisfactory end states between Jerusalem and Washington on this. I'm still of the view that the paramount decision maker will be the U.S. president. I think that the U.S. Machine will decide the overall duration and tempo and purpose of the conflict. But we are seeing a divergence. So and that's something to be tracking as well. And I think the third actor to be watching for me will be the Houthis. This week we saw the Houthis. To some people join the war. I'm not of that view. I think that the two missiles that were sent towards Israel, I'm interpreting is as a sort of reminder that the Houthis do present a potential to broaden and lengthen this war, should they decide to interrupt shipping in the Red Sea. They've not done that at the moment. I suspect there are considerable efforts going on to make sure that the Houthis feel that their best interests are served by not joining that aspect, that economic aspect of the conflict in terms of the Gulf. But at the moment, I'm interpreting this as a wake-up call, a reminder that they have the potential, they have the capability to make this a much broader war by interrupting shipping on the Red Sea.
how you're viewing stability within the region. How do the heightened tensions now play out between Iran, between Saudi, the Middle East, etc.?
So I think I'm taking a couple of points on this sort of longer term timeline about where the region is in any of these scenarios. I think we will see movements within the GCC community, and including countries like Jordan, to become more cohesive, more competent, and with greater capabilities in their defence, in their regional defence. I think that's got to be an outcome of this conflict in the longer term. I think there will be questions about the relationship between the Gulf countries and their security, the security guarantor in Washington. I'm not of the view that will be fractured. I don't think that will be significantly diminished. But I wouldn't be at all surprised if there's a greater hedging going on in terms of how the Gulf countries see their security moving forward. I'll be at that stage. I'll be interested to see what interest China expresses in playing a bigger part in the region. I'm not expecting the PLA Navy to be sailing or escorting ships through the strait, but I wouldn't be at all surprised to see Chinese commercial defense companies engaging in more marketing in the region as the region thicken up their defenses going there. I think there is a significant loss of trust in Israel's intentions in the region. I think there's also a degree of anxiety looking forward as to Israel's capacity to project its power in a highly sophisticated and effective way across the region. So I would be questioning whether or not the idea of normalization with Israel will be back on the agenda in the immediate future. In the longer term, who knows? But in the immediate future after this war, I think that may well be put on the back burner. So overall, I think, Imogen, I think we should expect to see the Gulf countries, including some other friendly states nearby, driving themselves towards a more cohesive sovereign defense capability, and that will involve some investment. I think we could see some hedging. I think there'd be interesting to see where China it positions itself in the aftermath of this war, probably commercially rather than in terms of defense presence in the region. And I do think that the idea of normalization with Israel, certainly in the medium term, is parked, given what's happened.
Ross, I guess give us an overview of how you are thinking about the economic impact of the war and what we know so far.
Yeah, thanks, Imogen. So across the main advanced economies, US, Eurozone, UK, and so on, our growth forecasts have come down typically by around 0.5 percentage point for 2026. So in the case of the UK, prior to the outbreak of war, we were looking for growth of 1.1% this year, close to where we think potential rates of expansion are, and that's come down to 0.6. So reflecting both weaker household consumption in real terms as real incomes are squeezed by higher energy prices, but also a sizable effect, we think, from business investment, given the heightened uncertainty, ongoing cost pressures. It seems likely that CapEx projects can be postponed. So those are the two main drags in the near term. Now, if we come out of this with growth of around 0.5% or a little above this year, I think that would, at this point in time, feel you'd take that. That would not obviously involve much by way of permanent damage or scarring to the economy. The unemployment rate would not obviously be materially higher on that temporary slowdown in growth. Before we get to the growth story, the sequencing, of course, is we are going to get this price shock, and our inflation forecasts have been revised up rather more, typically 0.5% to a full percentage point for 2026 as a whole. And again, just referencing the UK, where we see inflation peaking around the end of this year, the beginning of next year, the best part of 2 percentage points higher in CPI. And that is not entirely, but principally on higher energy. I think by the time we get to the latter part of this year, you will be seeing some second round effects begin to impact. I mean, foodstuffs would be an obvious one. The supply problems, pricing pressures on fertilizers and so on, I think are now quite well understood. Other transportation components, but as we know with energy shocks, and certainly since the experience since 2022, an energy shock is pervasive. Every sector is affected by this, and the fact that UK services inflation over 4 years down the line from the beginning of the Russian invasion of Ukraine, services inflation is running at 4.3%. You can see that. I think with that recent experience, the persistence of those indirect effects or second round effects was underestimated, and that's something which makes us a little bit nervous. And I think certainly for some central banks, including perhaps most obviously the Bank of England, does impose some constraints on how much policy discretion, how much leeway there will be.
How will the Bank of England be thinking about this and other central banks in the more, let's call it, kind of worst case scenario, a scenario where the conflict persists longer than your sort of, I suppose, central scenario, oil prices remain elevated for, 6 months or more? What would your projections look like then, and how do you balance that kind of growth versus inflation trade-off?
Yes, so our forecast, the latest sort of vintage, is running off energy futures strips, just really from a week or so ago. So, some good news in a sense priced in that, so far as you have these sort of downward sloping curves, not quite getting back to pre-war levels anytime soon, but nevertheless less intense price profile. The risk, of course, I think, is if we start to get more physical disruption in terms of those supplies. Those future strips are going to have to move up much closer to spot and remain at those levels for longer. So you then get into a situation where I think, initially, and we're still in these phases, where a slightly more intensive energy price shock, I think is obviously not only worsening your near-term inflation, but on balance, you're going to have bigger second round effect risks because the crisis is still manageable. The economy is not being derailed into a sort of full-blown deep recession. So really, the principal problem is a more intense inflation challenge. And so maybe some of that more aggressive interest rate pricing in markets starts to look a bit more plausible than perhaps it does at the moment. But then at some point, this is not linear. You will get there is a tipping point, I think, where you could see more aggressive layoffs, business insolvencies rising more aggressively. You get that permanent scarring. And on that sort of 2 to 3 year traditional monetary policy horizon, it's maybe easier to see a situation where your principal problem is really a disinflationary one. Now, that doesn't necessarily mean that central banks could be overly preemptive in cutting rates. But as I say, I think there is a slightly sort of hazy ground somewhere, probably not too far from where we are, where that balance of risks tips from an inflationary challenge to a more disinflationary one. As things stand, it feels like this is still a manageable shock, but the longer the crisis drags on without resolution, obviously the more intense those trade-offs. And as I say, I think for now, and even with moderately higher moves in energy prices, I think this is more of an inflation policy challenge than it is a growth challenge.
Ross, your answer to this question is a little bit implicit in the way that we've revised the bank rate call and the timings of those potential hikes. But the question is, how long do you think these second order effects will take to appear in the data?
Yeah, I think it makes more sense to think of these second round effects more as a sort of process of slow osmosis rather than a sudden a slow process of osmosis rather than a sort of sudden step change. So I think some of this will be evident, in the autumn, going into the final quarter of this year. Areas like transportation, for example, there is a bit more subjectivity inevitably when you try to model this. But to the extent that we've been guided by the 2022 experience, We see core inflation. It will dip in the next few months, partly on some of these budget measures. But then from around the middle of this year, we see core inflation running a little above 3%, as opposed to the low twos pre-war, and sustaining those levels well into 2027. Now, part of that will require some accommodation, if you like, through slightly higher wage inflation. But our wage inflation forecasts, we're sort of looking at, a sort of an ongoing sort of moderation over the next few months. But once we get into that key wage setting season, the back end of this year, around the turn of the year, we see some moderate upside pressure on wages. And so average weekly earnings running sort of 3.75% through the first half of next year. So if that wage path materializes, then I think that would be consistent with core CPI continuing to run a little over 3%. These things are always conditional. The CPI, conversely, to be much lower and getting back towards target consistent levels sooner, I think we would probably need to see greater wage moderation than what was expected pre-war. So not only firms not responding in any way to try and boost pay, but actually against that backdrop of broader cost pressures, squeezing wage inflation more aggressively. That could happen. It didn't happen for several years after the 2022 shock. And I think that it's that episode which ultimately makes us a little bit cautious about this idea that wage inflation is just going to fall away rapidly.
Let's just dig into that a little bit then, I suppose, in terms of thinking about the policy response. Whilst our sort of central scenario is that this is a manageable shock, how do you expect it to be managed? First and foremost, on the monetary policy side, have you revised your bank rate view as a result of this?
We see quite a bit of divergence on the monetary policy side. Our US colleagues are of the view that we will still see US Federal Reserve rate cuts beginning before the end of this year. We have pushed that cutting cycle out a little bit. First cut now coming in Q4. Some further, so October, December, and then another reduction potentially in January. It felt quite borderline anyway to us. This is not necessarily a sort of consensus view, but we'd had a persistent overshoot of inflation in the UK, and I think a lot more of that than was perhaps widely acknowledged was to do with excessive demand. Real GDP has been weak, real consumption has been weak, but nominal growth, GDP and consumption has been running some way above what appear to be CPI target consistent levels. So taking out the cut was easy enough. On balance, we think at this point, as discussed a little earlier, that the risks are more towards the inflationary side, and we have a quarter point rise penciled in for the fourth quarter of this year. The probability on that is certainly not 70 or 80%. It feels quite borderline. But that's the way we see the balance of risks at this stage. This is a potentially bigger inflation problem, at least for an inflation targeting central bank such as the BOE. And if they do cross that Rubicon and raise rates, it's probably then not one and done. We don't think a lot of tightening is going to be required. So our central case at the moment, albeit very conditional and with unusually high degrees of uncertainty, is for 2 quarter point rises in the UK, back end of this year, beginning of next. But the stronger, I think the higher conviction aspect of our UK view is that there isn't the scope to cut, and the BOE, because of the baggage it has from that post-2022 experience, just simply doesn't have the leeway that you might want to look through or assume in a sort of rather blithe way that first round effects will wash out very quickly. There won't be much by way of indirect effects, and inflation will effortlessly glide back to target. I don't think that is where we are.
And perhaps just to bring it back to a market's perspective, I think the point you make there around the timing of those hikes is is probably an important distinction between the way that we see this, potential, wouldn't call it a hiking cycle, but we see the potential hikes playing out versus what the market is pricing. The market has a little more than 2 hikes priced in by kind of the early part of next year, which is, maybe slightly more hawkish compared to our base case, as Ross has already been through. But actually, the bigger difference really is around the timing of those hikes, where the market seems confident, albeit over the last 24, 48 hours, a bit of diminishing confidence around those hikes coming earlier. Whereas we're very much of the view that if those hikes are delivered, they're probably more the second half of this year, and it's unlikely that there will be enough evidence by April, June, or even July for the Bank of England to be delivering rate hikes. The market obviously has been very focused on the inflationary impact of the war and what that means from a monetary policy perspective. But we've talked less, I would say, or the market has been focused less on what the fiscal policy response might be. So Ross, perhaps you could just touch on what this means from a fiscal perspective. And I think it's probably, increasingly important in the UK, a country that has, limited fiscal headroom. It's the fiscal backdrop that has, for a long time, been driving the outright level of yields and the shape of the curve in the UK, and the currency as well. And so I think it's an important piece of the puzzle that has taken a backseat to the monetary policy response. So I'd be keen to hear, your thoughts on any potential fiscal response.
Yeah, I think just as the scope for monetary policy discretion feels more constrained than in 2022, I think the same line of argumentation applies to fiscal. We've had a number of crises in recent years, going back to the global financial crisis, the pandemic, the Russian shock, and each time we had, by historic standards, speedy and very large fiscal intervention. But on every occasion, long after the original crisis had passed, or the effects of the original crisis, public expenditure never reverted to pre-crisis levels. So we've had this ratchet effect in terms of debt levels, still running excessive deficits, despite the economy not obviously functioning with a sizable output gap. So fiscal policy looks badly misaligned, and therefore I think there are inevitably limitations on what can be done. At this very moment in time, the pressures are still relatively modest. Obviously, it's principally through higher petrol and diesel. The sort of lagging nature of the UK's domestic energy pricing, the Ofgem price cap. Tomorrow, the 1st of April, we're getting a 7% cut in the Ofgem price cap. When we get the next quarterly reset at the start of July, we're looking at a 17% rise. So there is going to be a big step up in about 3 months' time. But of course, that will hit in the middle of summer, so less pressure in terms of heating and so on. And even when we get up to that estimated July level, sort of close to £2,000 a year, at that point you're only sort of £300 or so above pre-crisis levels. If you think back to the 2022 crisis, that Ofgem price cap peaked at close to £4,300. So we're way below those 2022, 2023 levels. Now, of course, this could still get a lot worse. But I think what that tells you is that whatever policy action comes will probably be quite targeted, quite temporary. The most immediate action will presumably be that the scheduled fuel duty rise, vehicle fuel, in September does not occur. The autumn budget, and maybe we have to wait until the autumn budget for more targeted support, presumably at targeted towards lower income households, those households on universal credit, say. I don't think we'll get the action we saw in 2022. The justification for those universal subsidies was, well, this is the only way you can get that financial support distributed very quickly. I think at this point, looking at where these energy costs are going to be, it probably doesn't require that type of response. So something more targeted, more temporary. there isn't a lot of fiscal headroom. Probably if you from the starting point of the OBR's estimates of headroom in the spring statement, at least half of that headroom has probably been burned up. Obviously, a few moving parts here, some that are revenue supportive through higher inflation, others that add to costs. But net, those higher gilt yields, slower economic growth, those forces are likely to dominate. And so I guess in extremis, the fiscal rules could be suspended or revised, but that's not optimal, because we have seen in recent weeks that when these sell-offs hit fixed income markets, you do often see an underperformance in gilts. It does feel like there's a little bit more vulnerability around the UK fiscally.
Yeah, I think that's a fair point, and something we've discussed a lot before, this kind of premium that gets attached to gilts, particularly when fiscal fears are abound. And the risk from the currency perspective is that fiscal fears start to dominate, and that even if we have kind of support from a relative yield perspective, with the Bank of England potentially hiking whilst the Fed potentially cutting rates, that actually that relative yield support can only go, so far. I think that's probably all we have time for today. If there's anything that we can do to support you and your business through these kind of unprecedented market moves, please do not hesitate to reach out. Thank you very much. Thank you for listening to this week's special episode of Bondcast, an edited highlights of a client webinar we hosted earlier this week with me, Imogen Bachra, Scott Livingstone and Ross Walker. If you liked what you were listening to, please don't forget to like and subscribe to our Bondcast channel, as well as checking out NatWest's other podcasts, Currency Exchange and Trade Links. Thanks, see you next week.